The topic of this essay is customer profitability, and since we're talking about customer profitability, that makes this part 1, section C. And our company here is TOR Industries, and we'll go ahead and read all of the information that we have. TOR Industries sells raw materials to its customers in the appliance manufacturing business. Rochelle Smith, a recently hired financial analyst, has been asked to evaluate the profitability of TOR's 3 biggest customers, A, B, and C, respectively. Smith has been provided with the following information. We've got a bit of information here. So we start here with units sold, the revenue at the list price, $18 per unit. So the price is the same for everybody. But we have discounts, and we can see that the discounts are a little bit different in terms of what that amount of discount is per unit sold. For company C, it's $1 per unit. For company A, it's a little bit more than $1 per unit, and B's in between there. So we have a revenue net of discounts for each customer. We have a cost of goods sold, again, $8.50 per unit, and so that's something that's going to be the same for everybody. And then we have our 3 different gross profit margins. Now, company A obviously has the highest gross profit margin, company C the lowest, but also company A had the most units sold to them, and company C the fewest units sold to them. So continuing, we get our customer operating costs. And we have product handling, 6 cents per unit, order taking, $2 per order, delivery, $365 per delivery, the rush orders, $200 per rush order. And if we look at this, we see that customer B didn't have any rush orders. Customer C had a lot more than customer A. Okay, if we take out that $200 per order, then we have the selling costs for each of the customers and total operating costs. And we see that the operating costs for C were less than they were for A, and B somewhere in the middle. If we go back to order taking, we see that company A had twice as many orders as company C, but if we go back to the quantity that we sold to them, we didn't sell twice as many. Okay, and so we've got some kind of relationships there that we're going to be looking at, or might come into what it is that we're talking about. And we have a little more information, our statistics, the number of orders. We see there A ordered twice as many as C, and the average order size. C had the largest average order size. And so when we start looking at these things here, like the cost per order, well, company C is going to be ahead in that. The per delivery, the cost per delivery, well, the fewer deliveries we have, the less that total cost is going to be. So that's all of the information that we are given. And then we have 6 different requirements. We'll read through them and then we'll work through them one by one. So what is required? First, identify which customer has the highest operating profit margin percentage based on net revenue. And we need to show our calculations. The second requirement, identify 3 factors that are contributing to this higher profit margin percentage. Third, the sales department has been given the goal of increasing the gross profit margin from customer C by $25,000 next year. If the gross profit margin percentage remains at its current level, how much more in revenue net of discounts is required to meet this gross profit goal? We need to show our calculations. The fourth requirement, recommend and explain 3 improvements in operations that would decrease customer operating costs and increase customer profitability. And 5, assume that each shipment is sent to the customer directly and each truck can hold up to 500 units. To minimize shipping costs, how many times per year should customer C be ordering? Show our calculations. And the 6th requirement, from the customer's perspective, discuss the potential costs and benefits of reducing the number of shipments per year. And just something to keep in mind here with the 6th one is we're supposed to discuss both the costs and the benefits. And so we're going to want to talk about each one of those in some way. But we start with requirement number 1, and we need to identify which customer has the highest operating profit margin based on net revenue, and we need to show our calculations. Well, we need to start with what is the operating profit margin percentage? What is it that we're even calculating? What are we doing to calculate this? And it's a very simple calculation. It's the operating income divided by the net revenue. And if we look back at the first page here, the first page of information that we're given, we're told what is the operating margin. Actually, I'm sorry, it's the second page that we looked at, the second slide of tables. We're told what the customer operating income is, and at the beginning we have the revenue for each of these customers as well. And so we don't really have to calculate anything new here. We just have to take this information out of what has already been given to us. And so the numbers here on this slide in green are taken right out of the information that we're given. And so if you look back earlier, we know that the customer operating income was $292,332 for customer A, $221,440 for B, $187,816 for C. And we also are given what that revenue net of discounts is for each of those three customers. And so we're simply putting into our calculator these three calculations, and we see that customer C has the highest operating profit margin percentage, 44.19. It's not a lot higher than any of the others. Okay, 43.31 is the lowest, but we have the highest being 44.19. So after we make these calculations, we need to make our statement. Customer C has the highest customer operating income margin percentage. Okay? They have the lowest amount of income, the lowest amount of customer operating income, over $100,000 less than company A, but that percentage of revenue, it's going to be the highest by just a little bit compared to the other two customers that we have. So then if we look at requirement number 2, identify 3 factors that are contributing to this higher profit margin percentage. And we've already kind of talked about some of these as we went through the information, but if we were to go back and look at it, we start with the higher percentage is due to, and keeping in mind here, they've asked for 3, so we're going to give 3 factors. First, they have the lowest level of discounts per unit. And so, remember we said that the discount for company C was $1 per unit. The discount for company A was more than $1 per unit. So by simply having a lower discount, they're going to increase that margin, the profit margin percentage, because they're having a lower level of discounts for that customer. Second, having larger order sizes, therefore lower shipping cost per unit and fewer order taking charges, is going to give us that higher profit margin percentage. Okay, we talked about that, the fact that the orders were the largest. And then there's a lower selling cost per unit sold, and that's back on the second table that we looked at. They have $300 of selling costs, and company A has $500 of selling costs, so they just have lower selling costs. Okay, so lower selling cost per unit sold is also going to help company C have their higher profit margin percentage. And remember, we needed to have 3 factors, and so what you're doing in your answer is you are numbering them 1, 2, 3. Help the person grading your exam see that you got the 3 points that they asked for. You answered the question that they wanted. So moving on to requirement number 3, the sales department has been given the goal of increasing the gross profit margin from customer C by $25,000 next year. If the gross profit margin percentage remains at its current level, how much more in revenue, net of discounts, is required to meet this gross profit goal? And we need to show our calculations. Well, when we're talking about our gross profit, again, we're going back to our first information, and we are told that the gross profit margin was $212,500. Okay, that was given to us. And we're also told that our net revenue is $425,000. Both of those numbers are taken right off the table, right off the information that they told us. And so we know that our gross profit margin is 50%. So if we want to increase our gross profit by $25,000, our calculation is to take that $25,000, divide it by the 50%, and as it says here, they would need to increase net revenue by $50,000. Okay, that's not a difficult calculation as long as we understand what it is that we're calculating. Notice here that this is gross profit margin percentage. The first requirement was about operating profit margin percentage. So we've shifted the focus here a little bit, looking just at gross profit in this question here. Now, moving then on to our 4th requirement, recommend and explain 3 improvements in operations that would decrease customer operating costs and increase customer profitability. Now, this isn't about a specific customer really, we're just talking about 3 improvements in operations. Now, if we look at the information that we have, going back to our first table here, units sold, revenue, discounts, Where we come down here to gross profit margin, this isn't operations. Okay, selling price isn't our operations. The answer to this question is going to come from the second piece of information where we have our customer operating costs, where we're calculating customer income. And so what we have here, this is where we're going to choose our improvements from. We have to do 3, but we have product handling, we have order taking, we have delivery, we have rush orders, and we have selling costs. So if we can reduce any of these, we're going to increase our customer operating income. And so this slide here, this table of information, is where we get the information, we get the answer to this question. So going back to our question, 3 improvements in operations that would decrease customer operating costs and increase customer profitability. 1, product handling. Okay? The first one, cost can be reduced by working with the customers to order in full pallet quantities, reducing pallet breakdowns and repalletizing costs. Also, fewer orders will reduce paperwork in the warehouse. Okay? So that's product handling, if we can reduce that. Order taking. Fewer purchase orders reduces the amount of administrative work to support the picking and shipping of products, as well as administrative overhead related to order entry, accounts receivable, credit collection work. There may be savings opportunities from automating the ordering process as well. Continuing, the third item was delivery. By filling trucks and minimizing the number of trips, shipping labor, fuel, fleet maintenance and delivery wait times and unloading costs can be reduced. Now, we needed 3, but we're going to go through each of these. Rush orders. By working with customers on better managing inventory levels, rush orders can be reduced or eliminated, resulting in lower costs and higher sales, okay, from reduced stock out. So that would be good to do that. And finally, visits to customers. This is working off of that selling costs number. By working more closely with customers, there's the opportunity to increase profitability for both the customer and supplier. Spending more time could make sense here if it leads to deepening the relationship with customer to identify shared saving opportunities with mature customer relationships. Visits to customers add value if they are fact-based and seek to deepen relationship by more closely tying the supplier to the customer's processes and aim to reduce the cost for both sides and expand margins. Now, in this question, we went through at the very beginning, there's the 5 line items in the operating income statement really, and so you're choosing 3 of those. Your description, your explanation of how it is that those things would increase our operating profit, they're going to be different than what I just read here. Okay, but if you've got 3 of those 5 items, you number them 1, 2, 3, you're going to get your full points from this requirement as well. So continuing, requirement number 5, assume that each shipment is sent to the customer directly and each truck can hold up to 500 units. To minimize shipping costs, how many times per year should customer C be ordering? And show our calculations. Well, this is actually a very simple question. We're asked about company C. We look back, we're told that they bought 25,000 units. Well, if each truck can hold 500 units, how many times per year should customer C be ordering? Well, we take the 25,000 units they ordered, we divide it by the 500 units that we can put in a truck, and they should be ordering 50 times per year. Okay, if everything worked out perfectly and all of that, it would be 50 times per year. So a simple calculation, but if we see the information, we do this calculation, we're going to get this easy points really with this requirement. And finally, requirement number 6, from the customer's perspective, discuss the potential costs and benefits of reducing the number of shipments per year. Okay, so the key thing is here, we need to say something about the cost to the customer and something about the benefits to the customer, because this is from the customer's perspective. See, we're talking about those meetings. We're going to go to the customer, try to encourage them to reduce the number of shipments, and we want them to do that, so we need to know how this is going to benefit them. And this is what we've come up with. From the customer point of view, good to kind of include that right there in the answer. Less frequent shipments will increase the amount of stock needed to be kept on hand, increasing carrying cost. Okay, so this is the cost of this. They're going to have to increase the amount of warehouse space dedicated to these products, whatever the case may be. However, these increased costs need to be weighed against the reduced costs of reordering and the reduction in the number of potential lost sales and or production downtime caused by being out of stock. Okay, so just what's the cost, what's the benefit of increasing the number of units that are ordered each time by reducing the number of shipments that are sent each year. So that's all of our requirements. Again, the key thing here in this was identifying that at the beginning we were talking about operating profit margin percentage, and then we switched in one of the questions to the gross profit margin percentage. But the information, a lot of the information we needed was given to us in the question. It's just a matter of identifying it and using it to answer the questions rather than trying to create new information or calculate information in order to answer the questions. Make certain you identify when it is that they've given you the information that you need to answer the question, and it's going to reduce the chances of you making a mistake by making unnecessary and unneeded calculations. So again, if we go through this step by step, look at each one, stay focused. Nothing in here that was terribly challenging, I don't think. We just need to recognize the information that's given to us and how it is we use it in this question.